Welcome back. We're at webinar number 7. It's been a great 7-week journey. Only had one mishap due to technology, so we're pretty happy about that. Again, all these videos are going to be posted on our YouTube channel, so once they're done, please take a look there, because I know a lot of you can't make it out every Wednesday at 11:30. So a little bit about Patel Wealth Management Group. It's a business that was started by my father back in 1981, and back then he was a stockbroker. Now our industry's changed so much from that stock brokerage type of business all the way to where we are today, which is wealth management. So we don't just buy and sell, shares of companies anymore. We take care of everything that has to do with the dollar sign minus accounting. A little bit about myself. I'm Sheehan Patel. I'm the Associate Investment Advisor of this team, and my role is essentially to, help develop the business as well as the wealth management side of our business, and Schick takes care of the investment management side. And today we're really, really excited because we have President, Founder, CEO of Harvest Portfolios, Michael Kovacs. So Michael, I'm going to put you live here, and I want to just tell us a little bit about yourself and how you came from where you were to Harvest, where it is today.
Sure. Well, thanks very much for having me. I appreciate the opportunity to talk to you guys. It's interesting when you're talking about your dad. I started off in the business in 1985 with Midland. Actually, I was with a company called Osler Inc. that was bought by Midland, but that was back in '85. And I was a stockbroker as well. The movie Wall Street was going, and everything was about buying and selling, and Gordon Gekko and all that. But it was interesting because I spent about 2 years building and prospecting my client base, and built up enough clients to get Wallop in 1987. And through the next number of years, we've seen all kinds of movements up and down in markets and volatility, if you will. But fortunately, I decided to make a change. I moved into the wholesaling side, or the investment management side of the business, back in the early '90s. And I went to work for Mike Lee Chin as well over at AIC. Mm-hmm. But I was fortunate enough that I came across Warren Buffett, and I was actually looking at a billionaires list, whenever it was back in the 1980s. Came across Buffett, and here was this guy that had made his fortune as an investor. And I started sort of reading more about him and understanding his investment philosophy about just owning great companies over the long term, and just trying to make, if you can make fewer really good decisions and hold on to them, it'll really change your life and change your investment portfolio over time. And working for AIC, the reason why I mentioned that is Mike Lee Chin at AIC had a very similar philosophy with their funds. So it just made sense to go there. I spent another 10 or 15 years in the business. When 2009 came around, and sort of the jump ahead, I had the opportunity to start my own firm, and I always wanted to. I'd always wanted to focus on a company that really was about generating long-term returns, generating income for clients, and I used that as the opportunity to start Harvest. So that was right at the end of 2009. Our first full year in business was 2010, and now we're just under $1 billion in assets, and we've got a very good ETF business growing now.
That's fantastic. Love that you brought up Michael Lee Chin. I remember Schick used to work with Michael Lee Chin. That's funny enough, back in the day. You kind of touched on it a bit here. We're going to jump right into the questions, everyone, if so you don't mind. You touched about, you heard about Warren Buffett, and, he was the way you wanted to start investing like him because he made a lot of money doing it. Why don't you just tell us about kind of like what your investment philosophy is? And I'm assuming your investment philosophy is all over Harvest. So.
Well, that's a great point, because when you look at Harvest, we are dominantly equity products. We do have one bond fund that we have farmed out to a large US manager to run, but we are predominantly, sort of 11 out of 12 products are equities. And that ties into that philosophy that we really believe that if you own good quality companies over the long term, you will prosper. If you own companies that are growing their businesses, growing their dividends, expanding their platform, you will do well over the long term. So in setting up Harvest and setting up the philosophy, we wanted to focus on what are the industries that have great growth prospects, what are the sectors that have great tailwinds behind them, like healthcare, or technology, what are the areas that we see as great growth areas. And then once we've identified that, we want to start breaking it down, looking at financial metrics, looking at the companies, looking at positions that we can own for a long term. We're an investment management company. We can't own things forever. Names change from time to time, but we really try to keep the portfolio turnover low and focus on long-term capital growth. So that's sort of the underlying philosophy of what we do. And as an investment manager, there's lots of competition out there. There's really little that we can offer from the standpoint of value to launch all kinds of products and have 70, 80 products. We'd rather focus on having fewer products, but really do a good job at what we do.
Yeah, you guys do a great job. We've owned a few of your products over the days, the tech one, the global gold one, that was the most recent. Right now we don't hold any, but I'm sure things will change as the sectors move. We're a little bit more active, right? Yeah. So you said that you guys are doing ETFs, 11 out of 12 are equity. ETFs, for everyone that doesn't know, there's exchange traded fund. And typically these exchange traded funds follow an index and have a multitude of different companies. Harvest is very different. They don't actually have tons and tons of companies within their funds. So why don't we turn it back over to you, Mike, and you can explain why you're trying to not be like the other ETFs out there.
Sure. Well, we're not index investors. We're a little more, we are from the standpoint of turnover, very low on the turnover side. But investment philosophy and history will tell you that if you have 20 or so businesses in a portfolio, you're getting great diversification. Most of our portfolios are 20 to 30, so that allows us to remain concentrated in those names or in those sectors, own a basket of very good businesses, and actually get to know those businesses very well, really thoroughly research them and understand them. If you've got 120 or 130 companies in a basket or in an index, you can't really know them. You really have to be a passive investor, and we're not. We're very active in our review. We go back and look at these companies continuously. Sometimes we do change names in the portfolio, like maybe up to 30% turnover in the year, and we're very active on the option side of the business. So that's something that we're sort of on a daily basis on top of. So concentrate, focus on a sector, really understand those companies, and that's again how we think we can add value to our unit holders.
Yeah, that's fantastic. You did mention low turnover there and 30%. What's the average hold time of a different company or whatever in one of your ETFs there? Or what, do you have a philosophy behind that, or how does that work?
It's really meant if we see a company fall out of favor, maybe there's a management change, maybe they made a directional change in the business or made an acquisition that we're not happy with, we will make a change in the portfolio. But I would say 3 to 5 years is sort of an average holding period. There's companies that we've had in there since we launched the ETFs, and even some of the funds were closed-end funds earlier that we converted into ETFs. They've been in there since day one. So It's a long-term positioning, but it's not buy and hold and pray. It's like we hold these we will hold these companies, but if we see changes or things that we don't like in the company, we'll make changes at that point.
Got it. Yeah. It's funny you said buy, hold, and pray. Chick and I always say the mantra buy, hold, and hope. That's why we're active. So it's just so good that we're on the same page here. Behind you on the piece of paper that says income happens here, and you touched on options and all of that. I guess this kind of leads me into my next question here. A lot of your sector-based ETFs pay a high yield or income, and the actual underliers don't have that much yield or income to pay. How do you do that, and how do, like, this is a different product for some of the investors out there that are looking for income. So why don't you just dive into that?
Yeah, well, happy to do that. And again, going back to our philosophy, it's about long-term growth and income. So it's a combination of the two. So the income, how we generate that is, one, we collect the dividends. So a lot of the stocks that we own, we want to make sure that it has a specific amount of yield that is a dividend payer, but that's only one portion, and that's a smaller portion. It's really the option writing that we do. So we will write or sell covered calls on our portfolio up to a maximum of 33% of the holdings. So what that means is we won't necessarily write on every single stock. There may be a stock in the portfolio, say a portfolio of 20, we may write options on up to 33% of one stock, but only 10% of another. It depends on how that stock's performing in the market. If it's had a really big run up and we've decided to write a bit more, if it's sold off a lot, we decide to write less. So it's Again, as I mentioned, we're not really active from the standpoint of changing the portfolio names, but we're very active in the option writing. So that allows us to capture and create that extra income for the portfolio. So each month, our investment management team will look at the portfolio, we'll look at what our obligation is that month and what we're collecting in dividends, and then we'll write the difference, the variable, if you will, to meet that income obligation. But our real long-term philosophy is to be as long as possible from the standpoint of having 70, 80% always long. Because when you're writing a bit of a portfolio, writing stocks, you're taking a little bit of the torque, if you will, out of the portfolio to generate that income. So these really are what we call equity income funds. It's a combination of both the equity, the NAV growth over time, but the income as well that we're generating through the option writing. So that's how we do it in a nutshell.
In a nutshell, yeah, no, it's I understand it. I want to dumb it down a little bit for our viewers here. You said option writing. Now, what is that, and how do you derive income from this? And in the easiest way possible, try to explain that.
The easiest way, if possible, it's still hard to explain because I've done it so many times. But writing, just another way of saying selling. So when you have a call option allows you to buy. It's a contract that allows you to buy a stock, say ABC, at a certain price, say $10 for a period of time, whether that's 30 days, 60 days, 90 days. In the case of Harvest, we only usually buy 30-day or sell 30-day calls. So when you buy that contract, there's a price, right? You have to pay a premium for that. So the opposite is like going short on a stock, we sell that call. So we don't actually buy the call, we sell the call, and we get the premium as a credit to the account, if you will, as opposed to paying the premium. Because we already own the stock, it's called a covered call. So we're not liable, if you will, for that potential short position because it's covered by the stock in the portfolio. So usually when you're writing or selling a call within a 30-day period, you have a very high premium. There's a higher amount of speculation there, and that allows us to create more income. As I said, it's conceptually, it's easy for us to talk about it, but I know sometimes it's hard to understand all this terminology. But really, writing calls or selling calls on a stock position you already own is a very conservative way to generate a little bit of income. So what we're trying to do is we don't want to sell a lot of calls. We only want to sell enough to help us pay that income, and we want to maintain as a big a position long, if you will, on the equities because we're long-term bulls. As I mentioned, we believe in the long-term growth of these companies. So we'll write enough to generate the income, and then we'll stay long the balance of the portfolio. Hopefully that's not confusing, but
no, I think that was really well said. Actually, you did a great job of telling everyone exactly how the writing portion works there and how it actually pays a little bit. And I'm really happy that you said it's not risky because when you do this covered call writing, it's actually way less risky because all you're doing is kind of picking up dividends, right?
It does, and it does actually take a little bit of the volatility out of the portfolio. As I said, a little bit of the torque out of the portfolio, but it's not that complicated a structure once you have it in place. And as a matter of fact, Harvest is the third largest call option seller or writer in the industry. And a lot of people don't realize that. We're out there, Bank of Montreal or BMO, and I think it's Horizons. We're the number 3 writer in Canada. So we're quite specialized in the area. We've been doing it since the get-go with our funds.
Cool. And then just this quick one there, you're trying to increase the income here. What's the target typically in between what and what?
Well, our income levels run anywhere from sort of 6.5% to 9%. And the only reason why say 9% right now is healthcare has come down a bit with the markets, with the COVID and so on. It sort of sold off the market. So the income level went higher. But we try to pay out about 70 cents per unit over the year. So that works out to anywhere from sort of 6.5% to 9% yields. And then we do have a couple of funds. You mentioned the gold fund, which is a little more passive. We don't have the option writing. That's more of a long position on gold or gold stocks. Same with our blockchain fund. But most of everything else we do is income driven.
Yeah, most of it is income driven. Maybe you could touch on a little bit right here about, how most of your investors are using your ETFs inside of their registered accounts, pension plans, what have you. How are people implementing them? I know you're not buying, taking all of your money and putting it in one. How are people using it?
Well, it's great that you asked that, because our research shows us that the majority of our investors are people sort of in their mid-50s and higher. They are either planning for retirement or they are retired, and they're looking for ways to grow their capital and generate income. Because we're in a real interesting situation right now where you've got zero interest rates in the world. That doesn't look like it's going to change anytime soon. And people are living longer. So if the average person might now be retired for 20 to 30 years, they've got to grow that capital. So going back to the original philosophy, we really think you need to own equities for the long term, because you're not going to get that in bonds or a lot of fixed income with rates already at zero. And then if we can generate that income for you, then that NAV growth will keep your capital growing, and the cash flow will generate the income you need. So to get back to your original question, whether it's healthcare or tech or whatever area these people are looking at, we find it's longer term income investors that are buying our portfolios. So they may already have portfolios with advisors like yourself, and they're looking for that equity income portion that they'll allocate to Harvest.
Yeah, I know, and you're so right. With the interest rates at almost zero, it's so difficult to generate any kind of income, and you have to kind of get a little bit creative. And if you look at CPP and all of those other guys out there, they're doing the exact same thing, right? So you got to use what you have to increase the income, because at the end of the day, you need some cash flow, especially if you're in retirement.
Exactly. I mean, think about it. I mean, you've got to go 10 years now on a US bond to get 70 basis points, which is ridiculous. I think a 30-year bond pays you like 1.2 or 1.3. I mean, it's unheard of. I mean, when I started in the industry, you could get 18% or something on a 30-year bond. It's crazy. So you've had this decline in rates, which has driven up the bond market, which has been fantastic. There's a lot of bond market geniuses that were created through that. But at the end of the day, what do you do now when rates are now at zero or right around there? So a lot of that upside torque may be gone. How do you generate that cash flow? Well, we think we've got a good method here that works.
Yeah, definitely. I know we actually incorporate Harvest into our portfolios, and when we look at it on a sector basis, they always give the upper hand to, if they're going to pay a higher income and also give us exposure to a certain sector, that's when we want to use you guys, because again, like especially for the tech achievers, for instance, right. Some of those companies don't pay much of a dividend, and if you can create a cash flow, right, owning those companies, then it's a win-win.
Yeah, exactly.
So that kind of is going to roll me into the next question here. Let's just talk about the tech industry. It's all over the news right now. Let's not drop any names or anything like that. But let's just talk. What are you thinking here? With some of the biggest companies are most of the index, and these prices keep going up. And now we're seeing some rallying in the market, and people are kind of like, let's get rid of our tech companies. What's your outlook on that space? Yeah, feel free to let me know.
Yeah. Well, it's been a real hot area. You're right, and as we know, markets can get ahead of themselves. Sometimes valuations can get ahead of themselves. But if you look at technology for the last decade or more, it's been the real innovators of the world. You look at what's happened with COVID and how we're doing this now over technology. I think about even 2009. The financial crisis, it would have been hard to have these types of conversations and use technology then. And even back in '87, when I first started in the industry, there was nothing like this. We didn't even have the internet. So you got to think what technology is driving, the way it's changing society is very exciting. So it'll ebb and flow. It'll get a little overvalued. It'll pull back. I think this is sort of part of normal market reactions. But I still think tech is a great place long term to be invested. So are we a little ahead of the game right now? We may be. Things can stay overvalued for a long time sometimes. But at the end of the day, aside from sort of normal market pullbacks, we're still very bullish on technology. We still think it's going to be a more dominant and growing part of our lives as time goes on. So whether it's driving your car, turning on your fridge from your car, or your air conditioning, whatever it may be, it's just going to get it's stuff that we can't even think about right now. It's going to be in our lives.
You're totally, it's so true. I mean, this happened, coronavirus happened in 2008, 2009. That's like when the iPhone was invented, first of all. We wouldn't have been able to do any of this. And like that, I think that in a nutshell shows you why you should be investing in technology companies, because they're the innovators, right?
What's funny about that is I remember, I've talked about AIC, but I remember having management meetings back in, I guess it was the mid 90s, discussing, should we have a website? Do we really need one? But now it wouldn't even be a question, right? I mean, you just think about the transactions and all the information that you get from websites. It's not even a question anymore. So out another 10, 15 years, who knows how things are going to be.
So it's funny you say that. People are also talking about the same thing on social media. Like they look up people on social media. If you don't have an account, you're basically non-existent, right? On some of these platforms.
Exactly.
So again, the real world has definitely changed a ton. Maybe you could touch on, I guess, because everyone talks about valuations and how it's, from year 2000 to where we are today. And I think a lot of people are scared because, some people have made tons and tons of money on some of these technology companies. What's your perspective on like back in 2000 versus today?
Well, 2000 was a very, very young, growing sort of dynamic industry. Everybody was jumping in there with, pets.com and all kinds of stuff. And valuations got actually way higher than they are today. There were some companies trading at 500 times potential sales and these types of things. So I think that market crash, that tech wreck, cleaned out a lot of names. New names developed. If you think about Facebook and Google, all these names that have developed since that point in time, and they've actually developed and built real platforms. A lot of those companies had no earnings. Today they have earnings. Today they're dividend payers. Apple's now a dividend payer. And they weren't at that time. As a matter of fact, Apple was almost bankrupt in '99 before Steve Jobs came back and turned it around. So I think these companies are actually true, solid, innovative businesses today. And whether you think they're a little bit ahead of themselves on the valuation curve, you can't even compare to 2000 how things were at that time. So I don't think we're in for any sort of triple waterfall tech wreck that we had in 2000. You really need a big exogenous event similar to what we just had with COVID, which knocked things down 30%, but now they've come back up considerably. So you're talking to a guy who's a long-term bull anyhow. I mean, that's my philosophy. That's my belief. I've never owned a bond. I never will, but I personally believe in long-term equity growth, and I'll continue to stay there, including with tech names.
Yeah, I'm in agreement with you. I'm like the same type of person. I think that, if you look at any chart in the world, it shows you that things just basically go up. Sure, there's blips along the way, but in the long run, it's going to happen. And as you get more and more innovative, you should be the ones that, make the most amount of money and be the most valuable companies in the world.
Yeah, just own quality. Own quality. Leaders, own the companies that are doing things, that are making the changes. And I think you'll do well. I think just stick with it. And when things sell off, buy them.
Buy more.
Yeah.
Well, I think I'm going to ask the audience, if you guys have any questions, just press on that button right there and type them in. If you don't, I think we're going to try to wrap this up in a few more minutes here. If you were talking to somebody that was going to buy your exchange traded fund versus somebody else's out there, what would be the one main important thing that you would tell them to buy yours versus somebody else's?
Okay, well, there's a lot of products out there, and there's some very good products out there. But if you want a long-term equity focus on great quality businesses that generates a great income for you, I think Harvest is the recipe that you need. I mean, with the standpoint of the income that's generated from the dividends, the option writing, and the long bias of our funds, I think you'll do just fine in an equity income investment. So we want to stick to quality. We want to buy quality, whether it's in our gold fund, which you mentioned, or in our tech or our healthcare fund. The same underlying philosophy is what you're going to get with Harvest. So we're very consistent that way.
Yeah, well, I think that nails it right on the head there. That's one of the reasons why we keep looking at you guys and using you guys. And again, we want to be able to use these products for our clients out there. I mean, if you guys have any questions about, what we were talking about today and how we can generate a little bit more income in your portfolio, and we could talk about some of these different products, we are more than happy to do so. And I know Michael and his team, even they can get on the lines with us and we can have a meeting together and we can try to sort something out here and try to just make your portfolios make more income, because I think it's super important to generate income, especially if you want to live off your couple $1,000,000 that you have and you can buy equities and just still generate income. That's a no-brainer in my opinion. So I don't think there's any more questions coming in, Michael. So I just want to say thank you very much for joining us today. We really appreciate all the insight and everything that you said today. And I hope we can do this again in the future. Maybe we'll talk about some other topic.
Sure. Well, I hope so too. We're looking forward to it, and we love working with you guys. So give us a call anytime. And if your clients have questions, please just pass them through.
Yeah, no, we will. I think that's the beauty of working with all these different partners, is that we're able to actually, help people all together, instead of just me doing all the talking. Like, I can get you guys to come in and help and whatever. I think that's really important. So I appreciate it. Well, on that note, I think we'll turn off the lines, and we will be back next week. Thank you, everyone. Thanks, Michael.
Thank you. Take care.
Take care. Bye-bye.
Bye.